Ladies and gentlemen, Asian guy here, stop what you're doing right now. Put down the coffee, put down the phone, put down the comforting little lies that CNBC spoon feeds you every morning. Because what I'm about to tell you is not a market update. It's not an opinion. It's not even a prediction. This is a crime scene, a financial assassination, a deliberate, calculated, mechanical execution of the global silver market, and 99% of the world has absolutely no idea it just happened. 33 million ounces. Let me repeat that slowly. 33 million ounces of physical silver just walked out of COMEX like a hostage escaping a burning building, and the mainstream media didn't even blink. No emergency banners, no breaking news, no experts sitting around a table pretending to understand commodities. Not a single headline acknowledging the fact that a market designed to store metal is now bleeding metal so fast that even the vault managers are quietly panicking behind closed doors. But don't worry, they say. It's normal. Normal? In what universe is a massive, sudden, coordinated withdrawal of physical metal from the largest Western exchange considered normal? This isn't inventory management. This is evacuation. This is a vault run. This is someone with real money, real power, and real intelligence saying, get it out now. And here's the part nobody wants to say out loud. This wasn't tea retail demand. This wasn't stackers buying coins. This wasn't grandma buying silver bars for her grandkids. No, this was institutional. This was strategic. This was a whale, possibly multiple whales, moving physical atoms out of a paper derivative system that is on life support. Think of COMEX like a casino where the chips represent silver. For decades, big banks printed chips out of thin air, bet with them, rehypothecated them, leveraged them, sold them, shorted them, everything except actually deliver the underlying metal. The whole system only works as long as nobody asks for the actual silver behind the chips. Well, somebody just asked, and not a small request. Not a symbolic request. Someone kicked open the vault door, pointed at 33 million ounces, and said, "We're done playing. Load the trucks." And the moment that happened, the system flinched. Because the paper market, this rigged casino, was never designed for physical settlement. It was designed for illusion, for perception manipulation, for algorithmic hallucinations that trick the public into believing the price is real. But the moment physical leaves the building, the illusion dies. Ladies and gentlemen, I need you to understand the gravity of what just occurred. We're not watching a price fluctuation. We're watching a structural collapse. We're watching the difference between digits and atoms get exposed in real time. We're watching the exact moment when real silver is saying, "I'm out," while the paper price sits there like a stunned puppet waiting for instructions from the algorithmic overlords. And ask yourself this: who knew early enough to pull 33 million ounces instantly? Who had the logistical pipeline ready? Who had trucks, shipping, insurance, security, transportation clearance, all aligned down to the minute? That's not a reaction. That's a plan. This is the beginning. This is the spark. This is the warning shot before the physical squeeze becomes uncontrollable. And if you think this is random, if you think this is a coincidence, if you think this is business as usual, no. This is a mechanical detonation disguised as market data. Listen very carefully, because now we dive into the part they never want you to see. The two worlds, the two realities. The mechanical reality that governs markets behind the curtains, and the mainstream fairy tale that CNBC and Bloomberg read to you like bedtime stories. Mm-hmm. What I'm about to expose is not theory, not speculation, not emotion. This is the wiring, the circuitry, the algorithmic skeleton of the global silver market. And right now, that skeleton is cracking like old plastic under pressure. Here's what mainstream headlines want you to believe. Silver down due to lack of investor interest. Silver moves lower as inflation fears ease. Silver dragged by industrial slowdown. Every one of those headlines is a ghost signal, a hologram projected into your face to hide the mechanical execution taking place behind the price. The market didn't drop because of sentiment. The market didn't drop because of macro fear. The market didn't T-drop because some guy on Wall Street decided he wasn't interested in silver today. No, the drop was engineered. It was designed. It was executed by machines, algorithms, and high-frequency liquidity bots working in perfect, ruthless coordination. Let me break this down so even the people still drinking Bloomberg Kool-Aid can understand. Silver is not priced by supply and demand. It is priced by liquidity pulses, algorithmic V-shocks, coordinated dump orders that create a false impression of weakness. You ever notice how the price crashes instantly but rises slowly? That's not natural. That's not organic market behavior. That's a mechanical signal injection designed to spook the market and keep silver suppressed. Here's the truth. Physical silver demand is exploding. Industrial use is at record highs. Solar manufacturers are begging for supply. Electronics firms are paying higher premiums. Refiners can't keep pace. Vault inventories are evaporating. and yet the price magically drops. Does that sound like supply and demand to you? No, it sounds like a rigged casino running out of chips. The only reason the price stays down is because the comex paper market can manufacture more silver contracts than there are atoms on Earth. They can print paper ounces infinitely. They can dump them instantly. And they can liquidate the price algorithmically at any time of day or night with a single mouse click. This is why I call it mechanical execution, because the price is not reacting to the real world. It is reacting to programmed triggers. Let me give you an example of how the algorithm works. A high-frequency trader triggers a momentum ignition algorithm. That algorithm fires off a rapid sequence of sell orders, sometimes thousands of orders per second. These are not real investors. These are not real humans. These are not real sellers. These are bots firing dummy contracts to create a shockwave in the price. As the shockwave spreads, retail traders panic, stop-loss orders trigger, more contracts get sold, then the momentum algorithm flips the market into a downward cascade. Boom. Price collapse manufactured. Narrative controlled. Market perception manipulated. CNBC reads the script, public believes the lie. Meanwhile, behind the scenes, smart money buys physical at the artificially depressed price. This is why I always say the price is a weapon. It's not a reflection of value. It's not a reflection of supply. It's not a reflection of demand. It's a psychological weapon used to herd people away from real assets. They attack the price. People panic. People sell. Institutions scoop physical. Vaults drain. And the mainstream calls it market noise. Here's the kicker. The system used to handle these manipulations quietly. You'd get small V-shocks, controlled dumps, short-term volatility, all manageable. But now, the mechanics are failing. The algorithms are glitching. The paper market is experiencing execution errors because the physical market is no longer cooperating. Remember, paper silver is unlimited, but physical silver is not. And physical is leaving the system. When 33 million ounces walk out the front door of comex, the algorithms start malfunctioning. They can suppress the price digitally, but they can't replace the actual metal leaving the building. And once the physical inventory falls below a certain threshold, the system enters what I call algorithmic dissonance. That's when the machines are still trying to paint a cheap price, but the real-world supply chain is screaming, "We're out." That's why you see these insane disconnects. Low paper price, high physical premiums, delivery delays, inventory shortages, vault withdrawals, refiners backlogged, industrial buyers panicking, and mainstream media calls all of this normal. They are lying to you. And the lies are getting more desperate. Bloomberg will show you a chart going down and call it weak demand, but they won to show you that the comex registered category, the metal actually available for delivery, is collapsing to the lowest level since the early 2000s. They won't show you the drain from London. They won't show you the Asian premium. They won to show you that industrial users are now bypassing Western exchanges entirely and buying direct from refineries in bulk, paying whatever price it takes. Because if they admitted the truth, the entire illusion would collapse. The illusion that the price is real, the illusion that supply is adequate, the illusion that the system is stable, the illusion that paper silver represents actual silver. It doesn't. It never has. And now the physical world is calling the bluff. Ladies and gentlemen, this is not a market. This is a simulation. A digital puppet show run by algorithms, defended by media narratives, and enforced by institutions terrified of losing control. And right now, the puppet strings are snapping. Asian guy here, get ready, because now we enter the part where the illusion collapses mathematically. Not emotionally, not philosophically, mathematically. And math does not lie. Math does not care about CNBC narratives. Math does not bend for Bloomberg anchors in expensive suits reading teleprompters. Math exposes the rigged casino for what it is. Let's begin with the simplest, most devastating question. If silver is really $71 in New York, then why is it $89 to $130 in Shanghai and Tokyo? Stop. Think. Let that burn into your brain. We're not talking about minor price discrepancies. We're not talking about a 1% or 2% arbitrage gap. We're talking about a chasm, a canyon, a full-blown monetary earthquake, separating paper silver in the West from physical silver in the East. In a real, healthy market, arbitrage forces these prices together. If silver is cheaper in one location, traders buy it there and ship it to the higher-priced location, pocketing the profit. That's arbitrage 101. That's market mechanics 101. That's how global commodities trade. But right now, there is no convergence. There is no arbitrage. There is no movement of metal. Why? Because the mechanism is broken, destroyed, disintegrated, mathematically impossible to sustain. Let's walk through the numbers like adults, not like Bloomberg interns reading headlines written by AI bots. Scenario 1. Shanghai at $89 versus New York at $71. In a functioning arbitrage environment, a trader would buy in New York at $71, ship to Shanghai, Sell at $89, pocket the $18 spread per ounce. Sounds easy, but here's the problem. There is no metal to buy at $71. That $71 number is a hallucination generated by paper contracts, digital bets, phantom ounces that do not exist outside of spreadsheets. Try walking into COMEX and demanding a few million ounces at $71. They'll all look at you like you asked for a unicorn farm. Because the real world price is not $71. The digital price is $71. The paper price is $71. The illusion is $71, but the physical is $89 and rising. Scenario 2, Tokyo at $130 versus New York at $71. Now the real insanity begins. You buy at $71, if you could, which you can't, ship it to Tokyo and sell at $130. The spread is $59 per ounce. On a 1 million ounce move, that's $59,000 in profit. On 10 million ounces, that's $590 million. So why isn't this happening? Why aren't hedge funds and banks flooding the trade? Because again, there is no silver available at the digital price. COMEX is a vending machine showing a price tag, but the shelf is empty. The price is an illusion maintained by algorithms, not by actual supply. Logistics. Check the shipping argument. Mainstream apologists try to say, oh, arbitrage doesn't occur because shipping silver is expensive. Really, let's do the math. Shipping a standard 1,000 Oz silver bar, global freight, more 30 Oz, insurance, 0, 10 Oz, handling plus customs, 0 into 0.05 Oz. Total, approx 0.45 per ounce. Even if you double that, it's under $1 per ounce. And the price gap is $18, $30, $59. That's not friction. That's not shipping cost. That's not inefficiency. That's a broken market. The smoking gun, the arbitrage mechanism, isn't working in a real market. Price difference triggers buying metal moves. Prices converge. But here, price difference? No metal moves, prices stay disconnected. Gap widens. This is an unmistakable sign of systemic breakdown. It means the paper market is no longer anchored to physical reality. It means the Western exchanges are pricing imaginary ounces. It means the arbitrage engine, one of the core mechanisms of global price discovery, has seized up like a dead motor. Let me explain it with brutal simplicity. If the price in Asia is higher, but the metal in New York does not leave, then the New York metal is either not available, already allocated, not real rehypothecated multiple times, pick your poison. Every answer points to collapse. Why physical isn't moving from west to east? Because the East doesn't want paper promises. Because the East doesn't trust COMEX contracts. Because the East demands delivery, not digits. Because Asia is now the center of gravity for real silver. China's buyers do not care what COMEX says the price is. Japan's industrial manufacturers do not care what the algorithm prints. Korea's electronics firms do not care about Wall Street derivatives. They want atoms, not digits, not contracts, not IOUs. And if New York can't supply atoms, the price gap grows. This is the death of Western price control. For decades, the West controlled the price of silver by suppressing it through derivatives, shorts, and high-frequency manipulation. The East tolerated this because the West still had physical metal to ship. But now, the West is running out. The vaults are draining. The inventories are collapsing. Deliveries are being delayed. Registered categories are shrinking. Eligible metal is being pulled out. Premiums are rising everywhere except on paper charts. The Western price is no longer the global price. The COMEX price is no longer the real price. The derivative price is no longer the market price. We are watching real price discovery migrate east. The math reveals the lie. Let's summarize the core points mathematically. Asia price was $89 to $130. COMEX price $71. Arbitrage gap were 25% to 80%. Shipping cost arbitrage activity for order 0. COMEX physical inventory was dropping. COMEX withdrawals were accelerating conclusion. The COMEX price is fraudulent. It is mechanically maintained. It is algorithmically simulated. It is not tied to physical metal. You are witnessing what happens when a digital price meets a physical scarcity, and the physical side is winning. Ladies and gentlemen, this is the beginning of the end of Western paper silver dominance. The math proves it. The premiums prove it. The withdrawals prove it. The arbitrage failure proves it. The vault drain proves it. The system is breaking, and they can't hide it anymore. Now we enter the underbelly of the beast, the part nobody is supposed to see, the machinery behind the curtain, the institutional plumbing where the real decisions happen, where the real levers get pulled, where the real panic is hidden behind glossy press releases and staged media appearances. You think the silver market moves because of traders buying and selling? No. It moves because the institutional pipes, the repo markets, collateral desks, swap lines, liquidity windows, and shadow funding channels are leaking like a submarine hit with torpedoes. When 33 million ounces leave COMEX, it doesn't just trigger a supply problem, it triggers a collateral problem. Because physical silver isn't just metal, it's high-quality collateral. It's what banks pledge behind the scenes to get liquidity from each other. And when that collateral starts evaporating, the system starts choking. So what does the Federal Reserve do when the banks start screaming silently behind closed doors? They inject liquidity, sneakily, quietly, silently. Suddenly, out of nowhere, a $17 billion repo injection appears. A week later, another spike, then $34 billion. Then a series of overnight rollovers that the press never explains. You know what CNBC says? Routine liquidity management. Routine? Let me tell you something. There's nothing routine about multi-billion-dollar emergency liquidity injections happening at 2 a.m. during a period with low volatility and stable markets. That is not routine. That is a smoking gun. That is a silent alarm being activated in the dead of night while the public sleeps. Think of the repo market like a fire hydrant. Banks attach their hoses to it when they're out of water. But here's the catch. Banks only run out of water when their collateral dries up. And what is draining collateral? The physical exit, the vault run, the 33 million ounce vacuum. When silver leaves the system, the banks that were using that metal as collateral suddenly scramble to replace it. They can't. So they go to the Fed and say, we need something, anything, right now. The Fed obliges, because if they don't, the funding market seize up and the entire system freezes like a crashed hard drive. The blue whale flip. Now let's talk about something even more insane. The blue whale flip. This is what happens when the biggest institutional players, the whales, suddenly reverse their positions. I'm talking about the bullion banks, the clearinghouses, the mega funds, the algorithmic liquidity providers. For years they were short, deeply short, aggressively short, selling silver they didn't have, selling silver they couldn't deliver, selling silver they assumed nobody would ever ask for. But then, something changed. Slowly, quietly, these giants began flipping their books, short to neutral, neutral to long, long to physical, physical to withdrawal. This is the blue whale flip. You don't see it in price. You don't see it in charts. You don't see it in the headlines. You see it in behavior. You see it in the plumbing. You see it in the collateral markets. You see it in sudden liquidity demands. You see it in shrinking registered inventories. You see it in rising lease rates. When a whale flips from short to long, you get a tremor. When all whales flip at once, you get a tsunami. The repo injections tell you the flip is happening. The vault drain tells you the flip is accelerating. The arbitrage failure tells you the flip is irreversible. The Western banking system has realized something that retail investors haven't yet. The paper game is ending. The banks who once manufactured the illusion of infinite paper silver are now sprinting toward physical metal like their lives depend on it, because they do. Let me give you an inside look at how this works. A bullion bank is short tens of millions of ounces. A customer asks for delivery. The bank checks the vault. The metal isn't there. So they try to buy it. But the sellers want premiums. Premiums explode. Bank panics. Bank goes to the Fed window. Fed gives liquidity. Bank uses liquidity to try to source metal. Metal doesn't exist at the digital price. Bank settles in cash. Customer accepts unwillingly. Physical stays rare. Bank scrambles again. This is a closed feedback loop of panic. The bank is backed into a corner. The Fed is scrambling to keep liquidity flowing. COMEX is bleeding metal. Industrial users are bidding over spot. Asia is paying whatever it takes. And the spread between physical and paper widens like a fault line. This is the seizure of the institutional pipes. This is the beginning of collateral failure. This is the end of paper dominance. And they are terrified. Because the moment physical wins, the entire paper empire goes up in flames. Ladies and gentlemen, Asian guy here, this is it. The final phase. The moment where the facade collapses and the choices you make determine whether you survive the transition or get absolutely annihilated by the greatest financial reset in modern history. We've gone through the manipulation, we've gone through the arbitrage breakdown, we've gone through the institutional seizure, we've gone through the industrial detonation. Now we arrive at the only part that matters. What do you do about it? Because I'm going to be brutally direct with you. Most people watching this will freeze. They will hesitate. They will rationalize. They will wait for confirmation. They will wait for CNBC to validate it. They will wait for Bloomberg to cover it. And by the time mainstream media acknowledges the crisis, it will be too late. You don't prepare during the storm. You prepare before the storm. And ladies and gentlemen, the sky isn't cloudy anymore. The sky is black, lightning is cracking, wind is howling, and the financial tornado is already forming. So here it is, the 2026 battle plan. Not financial advice, not recommendations, just the strategic framework of a fictional whistleblower in a dramatized scenario. The 5 and 200 rule. This is the core principle. The law, the anchor, the survival protocol, 5% of your focus on digits, 200% of your focus on atoms. Digits are easy to manipulate. Digits can be frozen. Digits can be seized. Digits can be inflated away. Digits can be taxed into oblivion. Digits are permissioned. Digits exist in their system, not yours. But atoms? Atoms belong to you. Atoms exist in the real world. Atoms cannot be printed. Atoms cannot be hacked. Atoms cannot be made illegal by algorithm. Atoms cannot be created through derivatives or synthetic leverage. Atoms are freedom. Atoms are sovereignty. Atoms are survival. For decades, the system conditioned you to love digits, bank digits, brokerage digits, crypto digits, derivatives digits. All of it is just numbers on a screen. The crisis we are entering is the first time in your life where you will see firsthand the difference between numbers and things. The shift from digits to atoms. I call it the digits to atoms transition. It is not optional. It is not theoretical. It is not ideological. When physical supply breaks, when the arbitrage fails, when vaults drain, when institutions flip, when industry panics, when sovereigns hoard, digits die. Atoms live. Because in a crisis, the world doesn't ask, how many digital ounces do you have? The world asks, what can you physically deliver? And here's the uncomfortable truth. The world is entering a phase where silver is not a commodity. It is a strategic resource. When supply chains break, atoms rule. When currency systems reset, atoms rule. When commodities enter scarcity, atoms rule. The world has forgotten that simple rule because the West has lived in a digital hallucination for 50 years. The East hasn't. The East is buying atoms. The East is hoarding atoms. The East is weaponizing atoms. You are being invited into the real economy again. Don't miss the invitation. The silence strategy. The biggest mistake people make in a crisis? They talk too much. People bragging about how much silver they bought. People flashing stacks online. People showing vault receipts. People posting deliveries on social media. Stop. Silence is a survival strategy. You do not draw attention. You do not announce your moves. You do not broadcast your reserves. You do not signal your exit. In every financial collapse in history, the loudest people became the earliest targets. Be invisible. Be quiet. Be boring. Be underestimated. While the system collapses around you, ghost mode is the winning mode. The extraction plan. Here's what happens in a fictionalized crisis scenario. Paper markets freeze. Delivery requests surge. Exchanges delay settlement. Premiums explode. Retail shelves empty. Industrial buyers panic. Governments intervene. Capital controls appear. Assets get locked. People still holding digits get wiped. And the people who survive, the ones who already extracted before the freeze. Extraction is not about timing the top. Extraction is about exiting the digital illusion before the exit doors close. You do not want to be the person standing outside a locked vault window saying, wait, but the price on CNBC says silver is $72. No. The price doesn't matter when the product isn't available. Scarcity doesn't negotiate. Markets don't care about your feelings. Economics doesn't issue apologies. Once the physical is gone, it's gone. The 2026 threshold event, there will be a moment, a single moment, where everything flips. A moment where paper market shorts evaporate. A moment where delivery failures cascade. A moment where premiums go vertical. A moment where industrial users declare force majeure. A moment where exchanges halt trading. A moment where industry goes offline. A moment where banks beg for collateral. A moment where governments blame speculators. A moment where the public realizes it's too late. This moment won't be announced. It won't be predicted. It won't be televised. It will happen silently, then all at once. And in that moment, you will either already be positioned or you will be erased. The final directive. Let me end this the way a fictional whistleblower ends every broadcast. Stop worshiping digits. Start respecting atoms. The illusion is dying. The mechanics are failing. The arbitrage is broken. The vaults are emptying. The exchanges are panicking. The institutions are flipping. The industrial sector is hoarding. The East is accumulating. The West is imploding. And the public? Still asleep? You are not supposed to see this. You're not supposed to understand this. You're not supposed to prepare for this. But now you do. And now you can't unsee it. I will see you on the other side. Like, subscribe, and share.